A swift global coronavirus pandemic has caused the fastest U.S. stock market sell-off ever and opened up a new nimble stock strategist game. How low can the stock market go? And how cloudy can the outlook become? Well, hopefully our chief equity strategist and economist, John Blank, can provide some answers for us. He joins me by phone now. John, since this whole situation is constantly evolving, is there any way to even answer this question definitively?
Yeah, I think so, Terry. We've got the stimulus package in, and whether you're unemployed or employed at a firm that imploded or in the hospital, any of those situations is now covered much more strongly and for a much longer period of time than the market probably thought. So I do think the bottom of it is in because the stimulus package is so strong across those three main planks.
So in a conference call that you and I were on about a week ago, to my surprise anyway, at that point, before this stimulus bill even became known, you said the market was right where it should be from a technical point of view. Obviously, you still feel that way.
Yeah, I don't see the market doing anything other than a very rational retraction in the face of an immediate public health response. And it was shocking and immediate that is the correct public health response, and the market just priced that in. So that is actually from valuations levels, we're going back to 2015-ish levels, not 2011 levels, which is going to shock a lot of people. And that actually isn't as bad as people thought. And that's what you need to understand is if you really look into the charts on share valuations, they're not as unrational as you might think.
I know you've read the stimulus bill that just came out recently. You say the bottom is in, you feel, on the market, but is it only a temporary bottom until the effects of the stimulus bill wear off for consumers?
It's $1 million question, Terry. And as I wrote in my teaser, you got to buy on yellow in this market. There is going to be no clear answers, and that's why you're getting cheaper stocks. And you just need to drive on yellow. That will not make anyone comfortable. I'm not here to make you comfortable. That's why you're getting cheap stocks.
So then large cap stocks are cheap at this point, not just confusing investors because they may go even lower than where they are now?
Well, let's take the Goldman Sachs line. S&P 500 earnings were 165 last year. They go to 110 this year, but next year they go to 170. So the market always looks forward, Terry. And if this thing is over by next December, you look forward on the higher earnings next year than we did last year, and you get stocks already passing where they already were. So just get with that program and believe in the event-driven shock we're in and not the cyclically or structurally driven collapse that, obviously is in the game, and you just have to drive on yellow in the face of it.
So because this whole situation is constantly evolving, John, is there anything actually driving the market right now?
What's driving the market right now is the VIX. And that VIX, what's blasting higher, and that caused a lot of clearinghouses and margin trading to force covering and raise cash. And that VIX is now declining because that need for cash is now declining. So a lot of that is actually receding. Keep an eye on the VIX options trading index. That's really your best tell on timing. And frankly, we saw the highest VIX ever, and that's usually a good time to buy. And that's what a lot of the top-down houses are pointing out.
What are the chances, John, that this coronavirus tips the world economy into a recession as countries around the globe are in lockdown to contain the outbreak?
100%, Terry. We're in a recession, 100% for sure. But it's going to be an event-driven recession, not a cyclical or structural recession, until the word comes out in 6 months that's otherwise. But at the end of the day, like I said, you have to go buy on yellow. That means get used to the fact that there's a huge risk involved here, or you're not going to get these stocks cheap. That's just how good investing is.
Is there even a way at this point to estimate the global loss due to the pandemic?
Yeah, there is. Chinese markets in the first quarter, the GDP growth rate was down 42%. In the second quarter, the best estimate people have is the United States will be down 24%. Those are going to actually see, plus 10% or even higher in the third and fourth quarter. So on average, the world economy will probably be a -1 or -2% growth rate annualized, which, again, step back and realize that is a recession. I don't argue with that. It's not as bad as you might think.
All right, we have a stimulus bill passed by the Senate as we speak. It's on its way to the House. Nobody is foreseeing anything there that's going to derail it. So if that's the case and it clears all hurdles, what has to happen for U.S. businesses to feel safe to begin normalizing economic activity again?
Well, we're in this shutdown mode. California's a good example, Terry. We have state directive that hits the whole state. And then there's higher levels of shutdowns are called, shelter in place or stay at home notices for San Francisco and LA, which are the urban areas. So this is kind of where we're going to be, which is a de facto population concentration metric. So out here in a more rural area where I live, I'm in a state order, but not under shelter in place. But the people in Los Angeles to the south of me and San Francisco to the north of me are in shelter in place. They are not moving. Two benefits to that. One is it contains these viruses within those cities and shuts them down in 14 days. So 14 days from now, we'll begin to see if it worked, 14 days to 21 days. And also it's shutting down those people to get to the rest of the state. For example, I'm in Santa Barbara County. We're the 19th in population. We're also 19th in coronaviruses, but we've only got 26 cases up here, not 800 like they do in LA.
So have you even put a percentage on the GDP contraction you're looking for going forward?
I would expect the United States annualized to be -3% this year. And I think Goldman's right, a -24% in the second quarter is probably right, and then you get +10 or so on the third and fourth. At the bottom line, the third and fourth quarter numbers are garbage because it's a public health emergency, and the public health experts will determine when we go back to work. And that is not an economist answer, it's a public health answer, and that will be derived from the data-dependent coronavirus cases. And again, for all those out there that want this thing to move forward then quicker as possible, I want to point out that second and third waves of epidemics can come if we get out of this too soon. That don't bet and don't want this to end quickly, because that can buy you those structural or cyclical recessions. You want to leave the public health experts alone to make a tough call and hang in there as long as possible until we're surely out of this. That would be better.
What do you see then as the damage to corporate earnings from all of this?
-20%. I mean, like I said, the Goldman numbers go from 165 to 100 and back to 170. So let's just average that out. 110 and 170 is a 140. So 165 to 140 annualized, about 20-25%. You got to remember, the market is forward looking. So it's going to start to price in 3 months of 170 and 9 months of 110. And then as we go into May and June, it goes 6 and 6 and so on. So as long as we don't get a huge structural recession in 2021, this market can rise from here, and it can regain all of its losses, which is typical for an event-driven recession, about 15 months to get back to the highs.
So with your view of stocks being cheap, drive on yellow, there are still stocks on your radar right now. They include Microsoft, SAP, and Regeneron.
Yeah, let's talk Microsoft first. $150 a share, Terry. That's a Zacks number 2 ranked stock. It was $185 back in February. Only $165 in January. So here's an example of how the market's pretty rational. You're only getting a $15 collapse in Microsoft stock. So definitely buy the dip on this one. But also notice that there's better values out there than this guy, but this is a classic example of a good stock you can probably make some money on. SAP, number 1 ranked stock. This is a big German stock. Again, this was 135. Now you're at 105. It's a big 30% downturn. So you've got a nice way to ride this baby up. It reports earnings on April 21st, which is a few weeks out, and they should do well. And Germany has got this under control, if anybody does. So that's a stock you should look into if you're interested in some international exposure. And the Regeneron is your classic pharma story. That's down to 430, which again, you could have bought this at 360 in February. So pharma stocks as a defensive play are holding up. And as long as that's the case, and this is the Zacks number one ranked stock, if you're looking for a safe harbor, Regeneron's your play.
Chief Equity Strategist and Economist John Blank on this global pandemic and its financial impact. And I know I speak for John and myself both when I wish everyone well out there. Hope everyone stays healthy as we all come together by staying apart. With John, I'm Terry Ruffalo. A reminder here, you can get advance notice of positive earnings surprises as Zacks Research Breakthrough is predicting with about 80% accuracy which stocks are going to beat earnings expectations even before those earnings reports are released. And you can go to zacks.com/promo for more details on how you can access that information.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.